anyone who was one of the early systems traders would confirm this, is that when we first got started technical trading, it was like shooting fish in a barrel because there were very few people doing it. Most of the people who were trading commodities were small investors or people trading by the seat of their pants. And so just the discipline that a system provided was an incredible advantage over most of the traders that were out there. So it turned out to be it was very easy. I mean, almost any system would work. Nowadays, things are much different. Those people are gone. The industry's dominated by systems traders. And so, it's a much different environment.
Now that I near 80, I realize with wistful pleasure that on many occasions I was 10, 20, 40 or even 50 years ahead of my time. This is a quote from Benoit Mandelbrot, who certainly influenced today's guest, and where you can probably also argue that he was many years ahead of his time when he started his trading career back in the early 1970s.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
Hi everyone, and welcome to another episode of Top Traders Unplugged. Thank you so very, very much for tuning in today. For those who are regular listeners, you know that my goal with the podcast is to share the stories of some of the greatest traders in the world and to ask those questions they don't usually get asked, to help you get more clarity, confidence, and courage to take your own trading or investment career a step further. And today's episode is no exception. Today you're listening to episode 93, and if this is your first episode you've ever heard, you might want to go back and listen to all of the earlier conversations.
This is Bill Dreiss, president and founder of Dreiss Research Corporation, and you're listening to Top Traders Unplugged.
And by the way, if you want to read the full transcript of today's episode, just visit the toptradersunplugged.com website and sign up to receive access to all of them. Now let's get started with part one of my conversation. I hope you will enjoy. Bill, thank you so much for being with us today. I really appreciate your time. Now, what's really exciting about our conversation today is that you, in many ways, are very unique in the sense that not many firms in our business that has been around for more than 40 years are still headed up by its founder, not even the firm that I work for. So I just want to say up front to everyone listening in today that it'll be worthwhile sticking around and learning from Bill's wealth of experience. But before we jump into all of the topics we're going to cover today, I just have this simple question that I try to ask all of my guests in order to appreciate the many different answers there is to this question. And it's basically how you respond when a person you haven't met before asks you what you do. How do you explain what you do, Bill?
Well, it's frequently difficult because most people don't have any reference point. Basically, I tell them I'm a commodity trader, and then I mention gold, wheat, and copper, things like that, and they say, "Oh yeah." So, and then I probably mention that I trade futures, and most people might understand what that is. But beyond that, and perhaps what I do is I say, well, it's something like being a hedge fund manager, and then that helps a little bit. But of course, it depends on the extent to which people have exposure to these kind of financial services.
Sure. No, absolutely. Absolutely. But anyway, we're going to stay with you for a lot longer and talk about your story. As you may know, I have a strong belief that you can't really understand a trader or a manager and his track record without understanding the background and the story behind it. So I'm going to start out by focusing on this today. So tell me a little bit about how it all got started for you, and you feel free to put some extra color on how you were as a young man growing up, or as a kid. Go back as far as you want.
Well, I think my pertinent history is that I graduated from MIT with a degree in electrical engineering, and then went on to Harvard Business School, and where I was attracted to Bayesian decision theory, and also just had an interest in operations research. So after I left school, I went to work for a think tank in California that was doing computer modeling of strategic and tactical warfare, and that introduced me to really state-of-the-art modeling. We were doing computer modeling mostly, although some of it was being done by hand. But this was in the days we were using the most powerful Air Force computers, which probably were comparable to today's pocket calculators. At any rate, we were really operating in state-of-the-art mathematics in many ways, so it was a very interesting.
How did you get into using Air Force computers? That sounds a little bit unusual.
Well, it's because of the type of work. We were working under Air Force contracts, and we were exploring different kinds of tactics in missile firing strategies, or ground wars in Europe and that sort of thing. And we were working for most of the work was done by young engineers with mathematical backgrounds, but the supervisors were retired Air Force officers.
Okay. And
one of them had done some commodity trading, and he interested me in commodities. And I became aware of Richard Donchian and what he was doing, and also started reading the literature of the day, things like Edwards and McGee, and started experimenting with the idea of developing systematic trading methods. Out of that came really the ideas that I used to develop my first system back in the late 70s.
Sure. So the thing, just to place this for the audience a bit. So leaving MIT and Howard, we're back in the 60s. Am I right in saying that?
Oh, I graduated from Harvard Business School in 1966, and then went to work. So I went to work for about 3 years or so in a think tank, and then after leaving there, I really focused on developing a trading system. And spent several years, 2 or 3 years at least, exploring that. And of course, once I got away from the think tank work environment, I didn't have access to computers, so most of the work I did was by hand. But nevertheless, I understood what it meant to be systematic. I had a big pile of CRB charts that I would go through and try various things. And partly for this reason, my focus, and partly from the influence of Edwards and McGee, my focus was on what would be typically understood as technical analysis, heads and shoulders and triangles and trend lines and so on and so forth. And one thing that I did early on is I went through the various chart patterns that were supposed to be significant, and I decided that the only one that really had any usefulness was a trend line, and perhaps support and resistance, and that all these other patterns were essentially like seeing images in clouds or reading tea leaves, and they really had no meaning. So I focused. So in terms of designing a system, I guess my idea, the thing that was perhaps somewhat unique, most of the systems that I was aware of, or at least methods that I was aware of, were numerically based, things like moving averages, whereas I was inclined towards trying to systematize certain aspects of technical analysis, as I say, like trend lines, and then be able to use trend line breaks as signals. And so I developed a system along those lines, And at some point it occurred to me, and again, this sort of happened out of the blue because I wasn't really aware of anything else going on along these lines. I thought, gee, maybe I can actually manage other people's money and make this into a business. Of course, I was unaware that perhaps other people were doing that at the time, but it was certainly a new idea to me, and a new idea, I think, at least where I was in the area where I was living, which is the Bay Area.
Is that where you grew up as well?
No. I grew up in West Texas and Kansas, went to high school in Kansas. And after I got out of school, then I had jobs in Southern California, and then I had moved from there to Northern California. So I just happened to be there at the time. What had a lot to do, or probably the main influence over where I lived and where I've lived since, is that after I got out of school, I learned to surf, and that became somewhat of an addiction, which has stayed with me ever since. One of the things that attracted me, I think, about commodity trading, it was something I thought that I could do from a lot of different places, anywhere I wanted to live, and I could live near the beach and have a lot of free time to surf. So, having developed a system, I decided it was time to perhaps learn the other side or learn something more about the industry. So I got a job as a commodity broker with E.F. Hutton in San Francisco, and I raised a few clients and traded my system as a broker for my clients. While I was there, I met some sales types, and probably about a year later, we left to form a company, Commodity Consultants, to trade managed accounts. In other words, they would be provide marketing. And
we're back in the mid-70s now, if I'm right. Is that, yeah?
Okay, at this point, we're at early 75, in the start of 1975. And about a year later, we split off, we reorganized, and I split the trading part off as a separate company, but we continued to work together for the next several years. At one point, I probably had 180 clients and probably over $10 million under management, which doesn't sound like much, but in those days it was big money. And, certainly among the traders I was aware of, I was probably the largest for a while.
And how did you, because I think this is important for people to realize, 180 clients, even today, that's a lot, even with all the computer power we have. But back then, it must have been an enormous task to handle. How did you go about doing that back then?
That was what inspired me to get my first computer. I had read the same ad in Popular Mechanics that Bill Gates had read. And what he did is, he quit school, and what I did is I went to Albuquerque and bought an Altair computer from the first computer store, which was assembled by the wife of the guy who owned the computer store, and brought it back because I was having the accounting, as you imagined, the accounting, and of course this was prior to having 180 clients. The accounting was becoming a nightmare to do by hand. So I thought, well, I really need a computer. And the idea in those days that an individual human being could own a computer was a miracle. So I bought an Altair and brought it back. Had to bring the hard disk back on my lap because it was so sensitive to getting out of alignment. Had a Teletype 33 as my keyboard printer. And essentially put the programs I had working with me, a couple of friends of mine who also were MIT graduates, and so we programmed the accounting into my computer, and I had an accounting system that was more accurate than the brokerage firms that we were dealing with, which is not saying much, I suppose, but that was really my first impetus to being probably one of the earliest adopters of personal computers back in 1976. We subsequently put my system on the computer, obviously, but as you said, the primary motivation, because of the number of clients I had, was to get the accounting automated.
Sure. And then you ran that for a period of time, but as far as I recall from sort of preparing for today, there was a time where you stopped actually managing outside money, if I'm right?
Well, I ran, as I say, I was quite successful for a while in terms of, my returns and raising money. And then I went through a period where I pretty much flattened out for a year or two. Since I was essentially using third-party marketing, and they were representing other managers. And of course, my clientele tended to shift to other traders. So at some point, my business ran down. It's not as if I really blew up or anything. It's just that my clients drifted away, and I have to admit that I grew a bit disappointed in my system, and at that point I pretty much closed my clients' accounts and just continued to trade for my own account, partly so I could experiment with various other approaches. And I also got interested in software development, so I shifted my business focus to writing custom software and doing computer consulting at that time. And of course, if you remember back in the early 80s was like the heyday of where personal computers were really starting to take off. So that in itself was an exciting time just to be involved in the computer industry.
Yeah, no, absolutely. But then in 1991, you decide to set up your current company. What made you refocus, so to speak, on the trading and the research? And how far were you really in terms of your research at that time, compared to sort of, what we're going to talk about later about how the strategy operates today?
Well, as I say, even though I moved out of the, out of managing other money, I continued to research and to do research and to think about various, ways of approaching the markets. And one thing that caught my attention and the attention of a colleague of mine that I've been working with was the work of Benoit Mandelbrot, Fractal Geometry. And there was a book came out in early 80s, I think, The Fractal Geometry of Nature. And it was apparent from reading this that this had application to modeling the markets. In fact, Mandelbrot's first paper that he published was on the cotton market. And that introduced the world. That was in compilation by Paul Kuttner called The Random Character of Stock Market Prices. That really was the beginning of Mandelbrot's career in fractal geometry, and of course, sometime later that we picked up on this, but we could see from this that it was applicable. And of course, another approach that was also popular at the time was the Elliott wave. Robert Prechter had really developed a reputation by his work in that regard. And so one of the things we were looking at is because the Elliott wave is obviously a fractal kind of approach where you have patterns within patterns within patterns, we thought, well, I wonder if it would be possible to automate the Elliott wave. Well, the short answer is no, and the reason is simply that if you have the kind of restrictive conditions that are invoked by the Elliott wave, the market won't cooperate. So you've got to essentially shoehorn the data into the model. What I found is that it was better to shoehorn or to devise a model that fit the data. And what came out of that was what we designated the fractal wave algorithm. And the fractal wave algorithm is essentially a method of deconstructing prices into a series of fractal patterns and once again, it's self-similar across scale, meaning that you have a short-term pattern that can be combined into a longer-term pattern, which can be combined in a longer-term pattern, etc., all of which have the same shape. And in fact, the underlying pattern is what we call a zigzag, which is merely the price goes up, the price goes down, and then the price goes up again. Or there's one in the opposite direction, of course. And you can then put these zigzags together. So if you have an up zigzag, a down zigzag, and followed by an up zigzag, then you have a larger scale zigzag. And then you can take that zigzag and have an up, down, and up, and then you have a larger scale. And that forms a fractal structure. Now, what is all this good for? Essentially, what I decided to use it for was be able to mechanically specify turning points in the price. And the easiest way to think about this is the Dow Theory, which has short-term waves and embedded in longer-term and medium-term, which are embedded in longer-term waves. So if you pick a particular level of the pattern of zigzags, you can use those points. That is, you can use the lows of those zigzags to draw a trend line through. Or if the trend is going down, you can use the highs to draw a trend line through. So this takes us back to the standard Edwards and McGee type of approach. This is essentially what we used as the basis of my trading system, the fractal wave system, which I use to trade. So once this system had been designed, I thought, well, okay, this is pretty interesting. So it's time to get back into the business. And I think through this time, I'd always maintained my registration as a CTA, so it was easy to get back into business. So I formed a partnership with, again, some marketing types, and off we went. So I think the attraction, the reason I found my system or the new approach attractive was twofold. One had to do with a theoretical basis, meaning that there'd been ever since the 60s, when there'd been this explosion of interest in the financial world, especially the academic world, the efficient market hypothesis and the idea that the markets were random walks and so on and so forth. There'd been an ongoing controversy, shall we say, between the academics and the practitioners about whether it was possible to actually make money in the markets by really any methodology. And of course, the academics were with the exception of Mandelbrot, took the position that the markets were random, and so it was futile to try to figure out a system. The traders, or people out in the financial world, were on the other side of that, and they generally, their argument was anecdotal. They could say, well, what about Warren Buffett, or what about various people who had demonstrated success? But of course, that argument was a little bit suspect because, if you have enough people out there doing something, some people are going to be successful just by chance. Somebody's going to win the lottery, regardless of whether it's chance, and nobody expects that to be due to skill on the part of the. So what I was interested in was something that was, shall we say, a little bit more convincing, and that's what Mandelbrot was providing, because Mandelbrot said that if you analyze the markets, and of course by that time, other people had taken up this approach also. You find that the markets, in fact, are not random in the sense of that was normally discussed, but actually had biases. In fact, the markets exhibited persistence, which meant that generally that if you had trends on almost any time scale, these trends would tend to persist a bit more than you would expect over a pure random walk. And so if you could demonstrate that persistence, which is possible using Mandelbrot's mathematics or using the fractal mathematics or power law analysis, then you had, in a sense, a theoretical basis, a scientific basis for saying that that it was at least possible, to make money in the markets by some sort of a trend following method. And then, of course, the next step was to use a similar kind of rationale to actually design a trading system. And so that's essentially what I did. Is a lot of the work that I was doing was not just a matter of designing a trading system. It was based upon analysis of the markets, of quite a few, generally the commodity markets, that indicated that these markets, in fact, exhibited persistence, and that there was a reasonable expectation that, trading systems would work. And of course, this applies not just to my particular approach. It applies, I think, to any kind of trading approach. In other words, the fact that, say fundamental traders or somebody like Warren Buffett or George Soros or whatever, the fact that they make money in the markets, as far as I'm concerned, is is for the same reason that I can make money in the markets. That is that these markets exhibit persistence. The fact that their analysis is different than mine, I think, is of secondary importance. And the same goes with trading systems. So much of the focus when people are evaluating trading systems is on the particular methodology that's being used. In my opinion, there's the primary reason that, say, systems traders and commodities are able to make money in the markets is that the market provides those opportunities. That is, it's the market that provides the returns more than the particular methodology that's imposed. And of course, you can see that if you compare performance, particularly among CTAs, is that, sometimes the markets are easy to trade and other times they aren't. And of course, that gets you into the whole idea of, every few years you hear that trend following's dead. Well, no, trend following's not dead. It's just sleeping. You go in and out of these phases, and it has more to do with the nature of the markets than it does with the vagaries of any particular system. Behind all this, this is all that I've discussed has to do with technical trading and designing systems. And of course, what I do is purely mechanical. That is, I run my program every day and I do what the program says. I don't second guess it. I don't omit trades or do anything of that nature. Obviously, the system's adjusted on a periodic basis just to sort of keep it up to date. But other than that, my system's been virtually unchanged for the last 25 years. But at any rate, my view on this is that underneath the statistics or the mathematics that describe markets are fundamentals. That is, I'm a technical trader that believes in fundamentals. And so I believe that markets, certainly commodity markets, are moved by supply and demand. I believe that financial markets are moved by economic forces, most of which are fairly long-term. I would call these business cycle moves. And so this has influenced me, along with just my research, to trade very long-term. That is, I trade off weekly charts, and I'm probably one of the longer-term traders that are out there. And of course, in one sense, that originally had to do with the fact that if you trade longer term, you trade less frequently, and that lowers your transaction costs, which I think is still important, even though commissions are so low these days. You still have to deal with slippage every time you trade, and so the less frequently you trade, the less of a load there is in that regard. But I think more importantly, I discovered that for the most part, if I traded longer term, I essentially got the same, let's suppose I had the typical trade, or the typical trend, I should say, might be several months. Now, a shorter term trader might take 3 or 4 trades out of that trend. It seemed to me that it's better just to take the whole thing. And of course, so you can step back a little bit and trade less frequently and still get the same benefit as if you were trading in and out more frequently. And in fact, you might even get more benefit because of eliminating a lot of the slippage. Now, of course, to some extent, this exposes you to a bit more drawdown exposure, because if you're trading longer term, then your stops are further back, so that it means that the markets individually can move much more dramatically against you before you get out. But I find that if you're trading a diversified portfolio, then that tends to mitigate it to some extent. And also, of course, you have, depending on the behavior of the markets, very frequently, where other shorter-term traders would be getting out and back in on a fluctuation in the prices, I'll ride through it so that I end up coming out at a better place, after a pullback. So, like I say, these things are all trade-offs in these various approaches, but I'm satisfied, certainly over time, that my risk control and my drawdowns and all that are certainly no worse than those that are experienced by people who trade somewhat shorter term.
So in terms, just to round this off in time frame, I want to go back and ask you a little bit about some of the things you've mentioned just now. But so in terms of time frame, you still run your systems only once a week, or are they run more than once a week, but just using a weekly bar for that matter?
I update the system, that is, I recalculate once a week. I have to obviously follow the markets on a daily basis because I get fills and I have to put in, if I go into a trade, I need to put in the stop loss and so on and so forth. So I need to maintain it on a daily basis, but no, I only calculate orders once a week.
Now, I want to go back a little bit. There's a lot of information coming about, Dow Theory and Elliott Wave and the fractals and sort of how these things play together. And also the fact that you, as you rightly said in the beginning, sort of started out by looking all at sort of traditional technical analysis, but also realize that there's a lot of subjectivity in that, and that's not necessarily a good thing. So automation became very important for you. Now, back in the 90s, I was working in London, and I was running a CTA there that was a pattern recognition. And it sounds, without me being an expert in any of the things that you mentioned, it sounds somewhat similar, where we had identified a number of patterns that repeat themselves and so on and so forth. But what we couldn't do in the 90s was we couldn't automate that. We couldn't, because it was based on some level of having a computer to recognize this. How and when did you manage to automate this? And because when you mentioned Elliott Wave, I think most people are familiar, or a lot of people are familiar with that, and they understand the 1, 2, 3, 4, 5 and ABC down, and sort of they understand that. But when you explain it, at least the way I understand it, is that the zigzags can form almost like an unlimited amount of different patterns. So if you can touch upon sort of the way you manage to automate that, but also the sort of the quantity of different patterns that you're looking for, if that can be sort of drilled down a bit.
Well, I normally don't think of what I do as pattern recognition in the conventional sense. That is, I'm not looking for heads and shoulders or triangles or wedges or that sort of thing. And as I said before, I decided early on that those were meaningless. And so whether or not I could automate that, it was irrelevant. So what I did is like I say, early on, I decided that the only patterns that really had any usefulness at all were trend lines and support and resistance, which are, pretty fundamental. Yeah. And then later on, when I got into fractal geometry, and again, thinking in terms of the Elliott Wave and of the Dow Theory, we identified the zigzag as the fundamental pattern. Now, once again, it's a very, you can say, well, that's pattern recognition, but it's hard to imagine a more fundamental pattern than that.
Sure.
If you understand what I'm saying. In other words, if you look for something more fundamental than a zigzag, you've got nothing. Basically,
you've got an up move or a down move.
Yeah, that's the pretty much ground zero in terms of designing. And of course, that's essentially the kernel or the basic pattern underlying the Elliott wave. That is, you have if you have a five wave is a zigzag with up down up, right? And a 3 wave is the basic zigzag up down up. Now the problem with the Elliott wave, as I said before, was that it restricted you to 5s and 3s, generally speaking. And if you actually worked, that's a top-down judgment. In other words, that's a fundamental belief or the fundamental structure of the Elliott wave is to impose that pattern onto the prices. If you go from the bottom up, where you say, okay, we're going to build this up from zigzags, and the zigzags are determined from the price. In other words, the price goes up, and then the price goes down, and the price goes up. Right? You're not imposing that pattern. That's a pattern that the prices, that the market itself is putting out there. Then you can obviously have more than shall we say 5 waves. They can go up and down and up and down and up and down, and can do that as long as it wants, and then it can turn around and do the same sort of thing. So if you use the bottom-up approach we did, then you can't insist that the waves be 5 or 3. They could be 7 or 9, or obviously not less than 3. But nevertheless, you can use those in the way that I described to construct a series of turning points at various fractal levels. And then, as I say, those turning points can be used. And again, this is different than the Elliott wave. In the Elliott wave, you're essentially using these patterns to predict. Anybody who's traded for any length of time realizes that prediction is impossible. Prediction is hard, especially about the future. So what we were using this for, or what I use this for, is not to predict. It's merely to provide a mechanical, an objective means of identifying turning points, which can then be used to draw trend lines. And of course, this goes back to Edwards and McGee, and the problem with something like with standard technical analysis is a technician draws a trend line, but 3 technicians will draw the trend line in 3 different places. But the fractal wave algorithm draws that trend line in one place, and it'll draw it in the same place every time. In other words, that's the whole idea. So what my system does is it takes technical methodologies, shall we say, or ideas that are traditionally based upon subjective judgments, and it implements those in such a way that they're mechanical or automatic, and that I think is the advantage. So, of course, the system itself will do things that to a technician would look irrational at times. But that's the trade-off. On the other hand, what the system does is the system provides discipline, and it eliminates the possibility of second guessing, which of course is the bane of the technical analyst. So the advantage to this, to get back, and this of course goes back to the original days when I got into this business, was that, and I think anyone who was one of the early systems traders would confirm this, is that when we first got started technical trading, it was like shooting fish in a barrel, because there were very few people doing it. Most of the people who were trading commodities were small investors or people trading by the seat of their pants. And so you had an incredible advantage, just the discipline that a system provided was an incredible advantage over most of the traders that were out there. So it turned out to be it was very easy. I mean, almost any system would work. I mean, Danshin's, moving average crossover. I knew a guy who had a system based upon a moving average turning. The moving average turned up, he bought, and it would turn down, he sold. So almost any system worked better than what most people were doing, which was taking the advice of their broker or just trading on their gut feel. Nowadays, things are much different. Those people are gone. The industry's dominated by people, by systems traders. And so, it's a much different environment. But by the same token, so one would think that this would all get arbitraged out over time. That is, if you had nothing left but
the big trend followers.
Yeah, big trend followers, and certainly trend following, dominates the CTA space. You'd think they'd just all be cannibalizing themselves, but I think this gets back to what I was saying, is that I'm a technical trader that believes in fundamentals, and so there's a world out there that can't be controlled, or that's beyond the reach of market psychology or market methodology, and I think that world, is subject to forces, generally longer-term forces, that are pretty much, universal and timeless. That
human
go back
behavior.
In history.
Yeah,
they go back in history as far as you want to go, and then we'll go into the future as far.
I agree with all of that, Bill, and it's interesting because there is obviously still so much resistance, I think it's fair to say, by a lot of people, certainly on the investor side, to embrace this, and you always have to justify, why trend following works, and even if it has a year or two of under average performance, then it's like it's their case for why it has stopped working and it's never going to work again. So certain things don't change. But I want to go back also at another point, which I think differentiates you a lot compared to the managers that we see out there. And maybe you can explain a little bit more that where I'm going with this is that I know that you, or at least part of your system, is not looking at parameters, meaning you're not trying to optimize a certain parameter set, whilst, if you use moving averages or price breakouts, whatever it might be, clearly a big part of the research is really identifying the right parameter sets to use. Explain to me a little bit about that, and why have you chosen sort of this way of looking at it?
Well, of course, the idea of data fitting has been the nemesis of anyone who's tried to design systems. And so one of the attractions to the fractal approach was that you're dealing, again, with very fundamental patterns, but you're dealing with patterns as opposed to numbers. You're dealing with sort of pictures instead of numerical approach. So in the first place, if you just the algorithm, the way that I've described it, is not a matter of optimizing on any kind of numerical parameters. It's a matter of setting up a certain structure and then in a sense graphically utilizing that structure to translate that into patterns. Now, there certainly is data fitting in the sense that you're fitting what patterns that you think are significant, versus those that you don't. You've always got to have some choice there. And for instance, trading weekly charts versus daily charts, that's obviously a parameter that you've selected. But these might be numerical parameters, but they've been selected on a qualitative criteria. They haven't been selected because I went through and tried all the different possibilities and picked out the best one. It was a much broader type of judgment that was made. So the advantage again is that in terms of designing a system, you're not really focusing. You're coming into it with an analysis that's based upon, shall we say, qualitative judgments about how the markets work and so on and so forth, and then that's implemented more or less directly without having to go through a lot of optimization and testing and so on and so forth. Now, obviously, you're going to backtest your methodology, and if it doesn't look like it works, you're not going to use it. So right there, you're data fitting. Nobody uses a system that doesn't test out. You certainly can't avoid that kind of parameterization completely, but you can certainly keep it to a minimum and also avoid being diluted by it. I think the worst thing that comes from parameterization is you tend to think you've got something that's a lot more, say magical than is actually the case. Now, I do have some parameters in my system, but once again, these are not optimized parameters. They're parameters that have fallen out of the patterns that form. So, for instance, if you think about these zigzags, if you have a certain zigzag pattern, and then you take a larger scale zigzag where you've got a zigzag made of, say, those zigzags, you typically are going to have, that's the duration of those zigzags is going to be about 3 times the duration of the shorter zigzag. Okay, and then the next level up, it's going to be about 3 times that. So you actually have some parameters that tend to fall out of your patterns, but they're not parameters that you just went and tried everything. They're parameters that actually are a result of applying your algorithm. And again, I don't vary those. So if I have for instance, I might use a pattern, a 27-week pattern. Well, I use 27 weeks everywhere. I don't use 26 and 28 and sort of thing. I just because once again the parameter has come out of the pattern. It's not something that's been independently derived or optimized.
Sure. Now, of course, we're going to talk more about this later on. But when it comes to risk management, though, parameters are difficult not to apply. You know, how much should I risk, et cetera, et cetera. And obviously, people usually come to these conclusions based on research and so on and so forth. How do you just sort of broadly frame that in terms of just the parameter side of things, not, you know, exactly the risk management? We'll talk about that a little bit later.
Well, yeah, but risk management is pretty much common sense, and everybody's risk management is the same. Anybody who's, you know, the risk management is driven by the realities of the business. And to some extent, of course, it's a matter of choice. In other words, I've decided to operate in a certain, so we say, level of leverage, and you find that the level I operate in is probably towards the high end among CTAs. If you get much higher than that, then you're out of business. But most CTAs, as they get big, they tend to cut their leverage, and so the typical CTA is probably about half of what I use. But again, that to me is pretty standard. In other words, I can just glance at somebody's performance record or whatever, just basic stats, and I know what region of risk or of exposure that they're operating in. And if you look at those people, you know, the people who are established and have been around for a while, they're all in the same ballpark. You look at me versus Dunn or, you know, various other people with similar risk, with similar, shall we say, standard deviations, monthly standard deviations, or similar drawdowns or whatever. You know, we're all doing the same thing. We all got about the same margin to equity. And so I think that to some extent, money management's another issue. In other words, once your system generates a series of trades which may or may not be correlated. Typically, you're going to have, about 40% winners and 60% losers, and on and on. And that's why I say that different people have different systems, and certainly from a marketing point of view, it's nice to talk about how special your system is, but you're really pretty much driven by what the markets are doing and what they offer you in terms of possibilities. And, someone who's, a well-designed system is going to do a reasonably good job of capturing what the market offers. But it's more of either you've got one or you don't. It's not a matter of that there's a lot of distinction in terms of what the outcome is. And once again, the outcome is pretty much driven by the level of the amount of leverage that you take. And if you normalize to that leverage, then anybody who's been around for a long time is going to have pretty much the same performance.
I want to jump to the next topic very shortly. I just have some maybe a little bit philosophical questions I wanted just to ask you. And I mean, when you look back at your career, which you may do from time to time, do you think back at this as some kind of quest you've been on to sort of perfect how to exploit the fractal nature of markets, or is there something else that drives you in if I can phrase it that way?
Well, everybody's got different motivations. I suppose when I first started out in this business, one of the things that attracted me to it was the idea that I could make a living, live where I wanted to, and surf a lot. I've really more or less surfing's been the sort of primary determinant of sort of where I've lived in my life. And so I saw this as a way of capitalizing on my, shall we say, my education and my experience in order to have a lot of leisure time. Mm-hmm. So I wasn't thinking in terms of, boy, how much money can I make? I was thinking more in terms of how much
can you get on the waves? Yeah, sure.
And for, I think, most of my career, that's been my primary focus. Now, the problem is it's hard to, if you're in a business that's about money, it's hard to ignore it. if you're a social worker or something, you can sort of ignore money and, get the satisfaction that comes from doing your work. But if you're in the money business, to some extent, money is how you keep score. I think if I look back, essentially my judgment is I'm probably a pretty good trader, but I'm a lousy businessman. I haven't really done a very good job of utilizing, whatever skills I've had in terms of developing a business. And as I say, part of it's just been neglect, and part of it has been I've relied, I think, largely on third-party marketing, which tends to be fickle. And so I've had ups and downs. I've had periods where I've raised a lot of money, and then it tends to, if my performance tapers off, then the money goes away. And that's just the nature of the business. You've really, if I had it to do over again, shall we say, from a business view, I would have taken much more responsibility for my own marketing, because I think that's how other firms of the same generation, like, Dunn or John Henry or people like that, I think their success is primarily due to the fact that they've been successful in marketing, and they've taken responsibility for that, as opposed to trying to farm it out on third-party marketers.
Sure, no, that's true. Now we're going to leave the background a little bit, but there's one question I simply can't avoid having to ask you, because it is so clear from how you explain it, and that is the importance of not surfing the markets but surfing the waves in the ocean. And that is, why is that so important to you, and how did that all got started? Because it seems to be something that has stayed with you through and through.
Anybody who's surfed realizes how addictive it can be, and I'm not the only one who's
caught the bug.
Found that to be a compelling. And of course, it's not just surfing. There's ski bums and golfers. There's people who do all sorts of activities, and not necessarily sports. But surfing becomes something that more than a sport. It just is really an engaging endeavor that, it's man against nature and a lot of other aspects to it. I've spent years surfing surf breaks in Northern California where there was nobody on the beach and nobody in the water. So, there are a lot of really attractive aspects of it. Plus, it inspires you to travel around to various places. It inspired me to live in Western Australia for 13 years, which is where I got started with my fractal wave system. It's a very engaging sport. I might also say that even from the very beginning, I had absolutely no desire to live in Chicago or New York and to engage and, to become a pit trader or any of that sort of thing. To me, that was just nuts. And I justified that partially by saying that I wanted to be as far from the markets as possible, so I wasn't influenced by that kind of groupthink. The reason, one of the main reason for being a systems trader is to insulate you from your own bad psychology, shall we say. And it's if you're surrounded by people who are, are surrounded by an environment of sort of opinions on markets, and then it's hard to resist that. So, in order to insulate me from that, I've done two things. One, I'm a systems trader, and two, I've stayed away from that, from those places. But the difficulty with that, again, looking at it from a business point of view, if you want to raise money, the place to be is Chicago or New York, not Western Australia, right?
Absolutely. As I'm sure you can tell by now, my knowledge of surfing is very, very limited. But since we all meet a few sharks in our business, I also have to ask you as a final question whether you, in your surfing, ever met any sharks in the water.
I've never actually seen a shark in the water.
Okay.
Except when I've been scuba diving, that sort of thing. But as a surfer.
Wow.
But I've certainly, when I lived in San Francisco, that area is called the Red Triangle, between Bodega Bay, the Farallones, and Monterey. It's probably the sharkiest place in the world. And in Australia, where I lived in Australia, is pretty sharky also. So they're around, but you're either on the bus or you're off the bus.
Right.
And it's surprising. I mean, not only are they around, but they're they're surprisingly abundant, surprisingly close. And I think the what you learn, one of the things that I don't know you can just be eternally thankful for, is that we're not on their menu.
Right.
And it's the same with killer whales. I mean, gee, if killer whales wanted to eat you, you'd be in bad trouble. But for some reason, they just don't have any desire to do that. So that's one of the blessings of being a surfer.
Well, let's hope it stays like that. Now, today, of course, we're going to talk a little bit more about the Global Diversified program, which is the name of your strategy. And also, it's interesting that I guess it's this year that you will be celebrating 25 years anniversary, if my math is correct. So I want to ask you a little bit about sort of knowing that what you wanted to achieve was also the location independence and so on and so forth. The fact that you've successfully run this now for 25 years, you've automated it to a large extent. You're clearly not doing everything yourself. So what kind of people have you surrounded yourself with in terms of organization in order to do this on a day-to-day basis?
Well, from an operational point of view, I pretty much did it myself until, in terms of the trading, until about 5 years ago or so. And now I've got someone who does most of the trading. I've got what might be called a virtual office. I don't have an actual office space, but I work from home, and then my trader works, out of Albuquerque. And then I have a programmer that's worked with me for a long time that's also remote. So in addition to that, my trading system's set up on a remote server. And this, of course, is primarily for security reasons. And also, the thing's got multiple backups and mirrored disks and all this. So we just log in using remote desktop to run the system. But, the system itself is once it was programmed back in 1990 it's been virtually unchanged. And so that it hasn't required, that is, there hasn't been any kind of maintenance that is done. Is mostly by adjusting the portfolios and various options, shall we say, that can be set, flags that can be set. But the program itself is pretty stable. The same is true with probably about 15 years ago, I had a program written to do my back office and to automatically read brokerage statements and compare that with my records and do that matching that goes on. So the end result of that is that it takes very little time to run the system and do the back office and the whole thing. Maybe a half an hour a day, typically, and a couple hours on the weekend, and it can be done by anybody who is competent and diligent and doesn't require a lot of technical skills. It just involves discipline and persistence.
So clearly, having done it in a certain way of running your business for a long period of time, even though there's been obviously some changes 5 years ago. The other impression that I got was that you do want to grow the business, from here. Do you think that in doing so, do you think that requires some changes on your part? Do you think that investors nowadays require a certain setup? You kind of alluded to it in terms of location, but I'm also thinking now sort of organization, infrastructure. I mean, you've been regulated by the authorities since the day that they got founded, many, many years ago. So everybody from the outside can see that you know how to run a business, but still, do you think that it requires some changes on your side to attract more assets?
Well, that's a good question. I know. On the one hand, I mean, I certainly have people that open accounts with me and are, and most of my clients currently in the recent past have been sophisticated investors who understand the business. They don't seem to have any concerns about the way my operations run. I've certainly got a lot of excess capacity in the sense that I could run a much larger AUM with my present structure without really changing anything significantly. Obviously, beyond maybe 30 million or so, I might have to start beefing up and maybe even get an office, but everything would pretty much run the same. So, and as far as my software goes, it's got, huge unused capacity. That is, I could trade much larger volumes and handle much larger volumes, through the back office with existing software. So I'm certainly not capacity limited. I think the limitations have to do with marketing. I think as time goes by, people have become, or I shouldn't say people, I should say probably more institutions, shall we say, have become more
tick box oriented.
Yeah, that's right. That's a good point. That is, and again, there's it can be justified. Everyone's got somebody to answer to.
Yeah.
Right. So the fact that I don't have a formal office and that I don't have a lot of employees, probably, and that I don't have a compliance officer and all that sort of thing.
But a lot of these things, of course, can be outsourced. Even, they can be virtual. That's one thing, but they could also be outsourced. But there is one question I outsource my performance calculations and that level of accounting, which is highly technical. That's also provides a certain amount of credibility in terms of my track record. In other words, I have NAV doing that, and so it's not like people might suspect that I'm, fudging my performance. There's one question though, Bill, that I have to ask, and obviously being a little bit frank about it, but as you've explained, people would have guessed now that you're not in sort of the youngest part of the CTA space you've been around.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.